Well, hello and welcome to the TandemGrowth 2024 investment review. I'm really happy that you decided to spend a few moments with us this evening, and really excited tonight. We're going to do a little different format. I've got a guest on tonight, Larry Swedroe, that I'll introduce properly here in a few moments. But again, happy to have you join us. As always, if you have technical challenges with tonight's webinar, you can reach out to Jamie Stoltz. She is at 770-641-6360, extension number 4, or you could email her at jamie@tandemgrowth.com. As always, we're welcoming your questions. We sent out a couple of communications in preparation for the webinar and asked you if you had any questions for Larry, and I've got a few here that we can talk about during the content and have room as well at the end. So if you want to ask questions, just type them in to the question feature. I'll monitor that. I want to take advantage of having Larry here with us tonight. So any questions you've got, just type them in, and we may answer them right in the middle of the normal content, or we'll jump on them at the end. But regardless, just type them in. I'll monitor it, and we'll make sure that we have plenty of time to cover what matters to you, because that's really what's important. So let me give Larry a proper introduction. Larry Swedroe was the head of financial and economic research at Buckingham Strategic Wealth for about 28 years. He's written a lot of books. His early books were some of the first books that really talked about the science of investing. And it was the only guide to a winning investment strategy you'll never ever need. Since that time, he's written 18 more books on investing and financial planning and wealth management topics, but he's an expert on what I call evidence-based investing. I started following Larry's work about 10 years ago as we were making changes to the way that we manage long-term portfolios. And so his influence has been in all of the strategies that we employ. A lot of his research and a lot of his work has been integral in helping us think through how to build better, more robust portfolios. His latest book is called Enrich Your Future, and it's a fantastic book as well. So Larry, thanks for being here. So happy you're able to join us tonight.
My pleasure. Thanks for having me.
Yeah, I had Larry on the podcast several months back, about the time he was making a transition from Buckingham, and I got an opportunity to have Larry provide some input to our firm on what we're doing in our portfolios. So Larry not only writes an incredible amount of material in a lot of major financial publications about the science of investing and how to build more robust portfolios, he's agreed to help our firm on a consulting basis to try to improve the work that we do for you. So happy to have Larry on board to help us do some of the work that we do in building and managing your long-term portfolios. As I normally do, I'll just give one slide here on the economic picture. And I guess what we would say about the state of the U.S. economy at the end of the year was it remained resilient, and I think probably more resilient than many had forecast. So GDP growth remained fairly stable throughout the year. Unemployment, again, moderated a bit, but still stayed well below its long-term average. And then the inflation picture continued to improve throughout the year, although there was a slight uptick at the end of the year. Larry writes a publication a couple times a year doing an economic summary, and he put one out early this year to cover last year, and he made some pretty interesting comments about the state of the economy. But Larry, what are your thoughts today about the economy? Should we remain optimistic that the economy will continue to expand? Any thoughts on that?
Yeah, sure. The first thing I think is really important to understand is there are no good forecasters of the economy. There are lots of people who think they're good forecasters. There are lots of people who get paid a lot of money to pretend they know what's going on. But one of the great ironies, I would say, is that I wrote a book called Think, Act, and Invest Like Warren Buffett. And Warren Buffett, one of the things he tells people is don't pay any attention to forecasters. He hasn't, I recently heard him quoted as saying, I haven't read an economic market forecast in 25 years. So with that said, what we can do is make some observations. And the important thing whenever you make a forecast, and I am a trained economist, I work for two of the largest financial institutions in the world, advising big companies and individuals on the economy and markets. So I have the background there and sold economic forecasts. But so what we could say is this: the economy does have a lot of good tailwinds in its favor. One of them is we still have a huge amount of fiscal stimulus. We're looking at record budget deficits at a time of full employment. We should be running surpluses now, but that's stimulus for demand. And a lot of the bills that were passed in the last administration are going to continue to provide some stimulus because of the funding for those programs. And they unfortunately named Inflation Reduction Act, which actually caused inflation in the country, and the stimulus bills on infrastructure. And then we have the US is clearly the leader in the world in innovation, and we're leading the world in AI and data centers. And just as one little tidbit for your audience, Amazon alone is going to be spending $80 billion this year on building data centers. Most people don't realize something like, if you do a Google search versus a search on the same subject using ChatGPT, you're using like 10 times the amount of energy. And everything is switching to using AI. We're going to need massive amount of not only data centers, but electricity infrastructure to go with it. So I think we're likely to see lots of continued stimulus given the economy going forward. And I would find it hard to believe, although it's certainly possible, and we should always consider, that we won't get the extension of the tax credits, because that would be a massive tax increase. Barring that, or barring a huge mistake by the president in imposing tariffs that lead to a trade war, that would be a potential headwind if you get retaliatory tariffs, where we impose tariffs, they impose tariffs, our exports go down and our imports go down, and the whole world heads into a recession. I don't think that's likely, but it's certainly something that has to be considered. The inflation looks to be on the right track, so that's a positive, although I worry because inflation is caused by excessive fiscal spending when you're at full employment. So that's another black swan type of risk. It could turn out that we have much higher inflation. That's my last comment briefly would be in the yield curve. I don't think there's a economist around today likely, and certainly among your listeners, if they knew with 100% certainty that the Fed would lower interest rates by 75 basis points in the last quarter of the year, that the 10-year yield, they would certainly have bet it would have fallen, and yet it's risen by 100 basis points for the reasons that I've been writing about for over a year, which is this problem with the fiscal deficit, and the US already now at 100% of debt to GDP. We're on a path, if that continues, in 10 years, we'll be at about 130%, and that's at or above the levels that Greece and Portugal and Spain were at when they ran into crisis. Yeah. Short term, I would say bottom line, economy looks good, unemployment likely to remain fairly stable, but there are these potential threats out there, and it's important to build portfolios that could withstand those potential headwinds should they appear.
Yeah, well, and what we see on the screen here now is the yield curve. Is, you know, we had an inverted yield curve for quite some time where short-term interest rates were higher than long-term rates, and we now at least have a marginally positive sloping yield curve, but and you've all experienced that. I mean, your savings accounts and your money market accounts are paying about 1% less than they were a year ago, but again, it's more normal than it was. In other words, the lower end of the curve has lower yield than further out the curve. You know,
Jeff?
I just looked up today on the 2-year yield, and the 2-year yield right now is 4.29%. So if you loan money to the federal government for 2 years, you're getting 4.29%. The 10-year is only yielding 4.65%. So you're not getting a whole lot of extra yield for going way out there. So it's really pretty flat. What do you think about all that, Larry? You have some comments on that?
First of all, I make this comment to help reinforce my statement earlier about there are no good forecasts. If you go back 2 years, when the Fed started, was raising rates, push rates way up, we had that inverted curve. Now, most of your listeners may remember there were many economists saying the best predictor we have of recessions is an inverted yield curve. It's been 100% accurate. And of course, we never got that recession. So that's number one. Second thing, if you go back to at the time the Fed was when interest rates were still low before they began to raise them in 2022, if anyone could predict the short-term interest rates, it should be the Federal Reserve, because they don't control the long end, but they do control the short end. And their dot plot did not predict anywhere near the rise in rates that we got. So it's often surprises to the economy that lead to both changes in interest rates in the stock market. And by definition, surprises are not forecastable. And that's why Warren Buffett tells you to ignore all forecasts, as he does. As to the yield curve, what the academic empirical research shows is that when the yield curve is steep, meaning the longer ends are much higher than the short end, and on average, the yield difference between the 1 and the 10-year has been about 180 basis points. As you pointed out, today it's about 30 or so. And so when the curve is steep, that's when everyone's afraid of rates going up. That's when you've been most rewarded for taking the risk, because that risk was already built into prices. When the curve was flat on average, which it is today, and you're not paid much more, on average, you've been better off staying at the short end because you weren't getting compensated with the risk. It doesn't always work that way, but the best we can do as an investor is put the odds in our favor. So that's telling you today, you probably don't want to take too much duration risk. On the other hand, you want to be careful and not sit all your money in cash, because there is the risk that, one, inflation could come down. We could get a recession and rates would then go much lower. And now you're stuck reinvesting at lower rates. So somewhere in that short or to maybe 5-year maximum maturity, I would suggest today would be the more prudent strategy.
Yeah. And the current yield on bonds is historically been a pretty good forecaster for subsequent returns. So it has information in those yields that give you historically a pretty good guess on what you might earn on those bonds in the subsequent year. So this is a chart that JP Morgan puts out that shows on the x-axis the starting yields, and this goes back to 1976, I believe. Mm-hmm. And there is a direct correlation. So when yields are low, your subsequent returns are low on bonds, and when yields are high, your subsequent return are historically the next several years are a bit higher. And they're forecasting based on the current yield on the aggregate bond index, which is corporates and governments, is, it's yielding a little bit less than 5, and they're projecting out, an expected return of about 5. So there's nothing, that's pretty, that's pretty helpful in terms of expectation management on what you're likely to earn in portions of your bonds, at least. Now, one of the questions we get a lot, Larry, is You know, if I'm getting, you know, if I'm getting 5% in cash, or now you're getting about 4% in cash or a little less, why do I even bother with bonds or taking the risk of stocks? And you know, this is a chart that everybody on this call has seen many times. It's just the chart that shows the major asset class returns over time. And if you just look in the bottom right corner, you'll see that from 1926 through the end of 23, this chart's through the end of 23, that if you invested your money in short-term treasury bills, which is like your savings account or your bank account or your money market account, you would have earned, your dollar would have grown to $23. And if you look right under that, you'll notice that your dollar just invested at the rate of inflation would have grown to $17. So cash is an important thing to own for short to intermediate, short-term needs. But after the impact of inflation, it doesn't keep up. And after the impact of taxes and inflation, you probably have a negative return. So while cash is the appropriate investment for short-term needs, and that's why we have short-term portfolios to meet those needs, you're unlikely to get a real return to fund your long-term financial goals. So that's the danger with cash for your long-term goals in your financial plan. Another question we get a lot, and of course we got it even more at the end of last year during election season, is the impact of various administrations on the equity market or the stock market. And as I mentioned in a webinar and a meeting we did, we think it's a really big mistake to let your political views influence your investment policy. And so this is just a slide that shows markets over time with different administrations. There's a similar chart that you see here that gives you the same type of information with who controls Congress. Larry, I know you've written a lot and you've read and a lot of research around the impact of our political views on our investment outcomes. You mind sharing some of those thoughts?
Yeah, there's some very interesting research from the field of behavioral finance, which is the study of human behavior and how it impacts our investment outcomes. We're human beings and we make all kinds of mistakes. One of them, most common, is overconfidence. It doesn't matter what the question you ask. For example, are you a better than average driver? Well, only 50% can be better than average, but 80 to 90% of the people answer that question positively. And a little bit of humor example of that, a recent study looked at this issue about, are you a better than average driver? And the study was done specifically asking the question about the last time you were driving where you were better than average driver. And the sample was people who were in an accident and found to have caused an accident. And they were interviewed in the hospital and asked, are you a better than average driver? And something like 80% of them said they were better than average driver at the time, even though they had caused the accident, right? So that, being overconfident is actually a good trait for most of us. Imagine if you woke up in the morning and looked in the mirror and said, I'm dumb, ugly, stupid, and everybody hates me. So feeling good that people like you, you're friendly and you're handsome or beautiful or whatever, it helps us get through the day, okay? But being overconfident is not likely to cause you to drive at 90 miles an hour in a driving windstorm and hurricanes and blowing through, and you're driving down local streets, so your brain operates there. But if you're overconfident about your ability to pick stocks or time the market, you're likely to trade a lot. And the evidence shows that the more you trade, the worse you do. So the more confident you are, the worse you're going to do. What does this all have to do with the politics question you asked? So think about this logically. Let's assume, for argument's sake, Jeff, that you happen to be a Democratic-leaning voter, and it's a Republican in administration. They're in charge of the presidency, Congress, etc. And we get a recession. Are you going to be confident, or will you be more confident than your Republican friends, or less confident than your Republican friends about the ability of the administration to do the right things, enact the right policies to get us out of the recession. What do you think?
Yeah, I would think that if the party that I'm not affiliated with is in power, I'd be less confident.
That's right. And that causes you, we find out, to be more likely to panic and sell and abandon your plan. If the party you favor, say you were a Democrat and Obama was in power and we had that horrible great financial crisis when he was taking over, many of the Republican investors would bail out because they thought he would fail or worried he might fail. Well, the Democratic voters were more likely to believe they would enact the right policies. And what the research shows is that when the party you're in favor, that you favor, is in power, you outperform the other people whose party is not in power. So that under the Bush administration and the Trump administration, Republican investors outperform Democratic investors and vice versa. So under Obama and Biden, okay, you were more likely to outperform if you're a Democrat. And it wasn't because you picked better stocks or anything. It's simply you were less likely to panic and sell. And markets, as you show rightly in that slide, tend to go up over the long term. So the best advice is, whatever you think, you should ignore your political biases, and your plan should incorporate the likelihood that there will be tough periods. About 3 out of every 10 years are down. About once a decade on average, we get really bad bear markets, like down 30, 40, 50%. And you've got to be prepared in your plan to stay the course, and even better, with your help, Jeff, they are able to rebalance and buy after periods of poor performance, which means you're buying low, and then you sell after periods of good performance, you're selling high, which is everybody's dream. But most people do the opposite. They sell after periods of bad performance in a panic, and they buy only after things have fully recovered, and now they're paying much higher prices.
Right. So I'll do the next 2 slides fairly quickly because I reviewed this in our statement video, the client's guide, and it's not, we're here at the end of January, so this is not new information. So 2024 was a satisfying year for equity investors. I mean, this is the MSCI All Country World Index, so this is global stocks, and it was a satisfying year. And you've seen this chart many times that kind of ranks the returns of various asset classes through time. And the far right column shows you the 2024 results for these broad asset classes. So, U.S. stocks were up 25%, small company stocks about 11.5%, high yield bonds 9%, emerging markets 8%, commodity linked investments about 5%, cash about 5%, real estate securities up about 5%. International stocks up 4.3%, and bonds up about 1.3%. And so the middle line there that you see with the line through is a portfolio constructed as out of those choices that JP Morgan puts together. That's approximately 60% stocks and 40% bonds, and you can see that mix was up 10%, which was about 7% more than inflation, which is high. It's really high return historically in a balanced portfolio. So it was a pretty satisfying year for balanced investors. But, and again, we've shown this slide a lot in the last few years, it is a fairly concentrated market when you look at the S&P 500. So if you look at the top right chart there, you will see that the top 10 stocks in the S&P 500 make up almost 40% of the market cap weighting of the S&P 500. And if you look at the top left chart, you'll see that those 10 stocks at the end of the year were trading at about 30 times earnings, much higher than the market itself. So it's a pretty concentrated market, concentrated in a handful of names. So Larry, what are your thoughts on this? Is this something that investors should be concerned about?
I think investors should be concerned about it because it's not as diversified a portfolio as is normally the case in when you have broader market value. I don't think you should try to time the market based on that, because here's the evidence. Number one is that the PE ratio, if you invert it, so you get what's called an earnings yield, or E over P instead of P over E. That's the best predictor we have of the future real returns to stocks. Okay? So when the PE ratio of the S&P 500 is now at about 23, that's telling you that future real expected returns are about 4.5, and add maybe 2.5% inflation, and you should only expect 7 versus the historical 10. But for the growth stocks in that index, which are dominating the index, they're trading at over 30 PE, and the Magnificent Seven are trading, last I looked, at over 40.
Yeah.
That's really dangerous, and it's a reminder that when we've had periods like this, both in the 1960s, ending in about 65, we had a spectacular 15 years after the Korean War, up to 65, and returns were, in the high teens. And then the next 17 years, stocks underperformed Treasury bills.
Yeah, we've got a couple slides.
So that's a warning. We saw that same thing happen in the late 90s. So there is this warning. What you should understand, though, is the rest of the market. If you look at value stocks, historically, you've had growth stocks trading at about 18 and value at about 12. Well, now you got growth at 30, but value still at about 12. So while the market is highly valued, there are parts of the market, particularly small and large value stocks, that are trading much closer to the historical averages, which means their expected returns are now better. That tells you nothing, though, about next year. Let me give one good example briefly about that. 1995, I think it was, this Christmas, Alan Greenspan, then the head of the Federal Reserve, coined the phrase irrationally exuberant market, because the PE ratio at the time was in the high 20s. Well, of course, the next 4 years were the best years the market maybe has ever had. So he was right, because then you had a crash, and the 13 years from 2000 to 12, again, 13 years, the S&P underperformed T-bills because valuations had gotten so high. But 96, 7, 8, and 9 were great returns. That's telling you, just like many forecasters, Jeremy Grantham, John Hussman, these are well-known names in the investment community, run billions of dollars in mutual funds. They have been predicting market crashes for a long time, and the market has ignored them, right? So what you have to do is have the discipline to stay the course. And I think the best way to do that is to stay more diversified and not have all your assets in an asset that looks extremely highly valued.
Yeah, let me get to that, because that is a big question that we get these days. Is why do I need a diversified portfolio? We've had this great run in U.S. stocks, and so and I posed this question to you. I said, this was several months ago. I said, the thing I'm hearing from people is, why do I need international? Why do I need small caps? Why do I need value? Why don't I just buy the S&P 500 and call it a day? And you sent me some really good illustrations, and I would love for you to hit a couple of these if you don't mind. So these are some of the slides you provided. So the first one was really talking about the behavioral biases that cause us to abandon a diversified portfolio. So any comments on this particular?
One is relativism. Unfortunately, instead of thinking about, is my plan on track? What's my goal? Am I getting the returns that I need to get? They look at the performance of some popular benchmark that maybe their friends are invested in, the S&P 500 or total market index. That should be irrelevant, because if you wanted, and it gave you the reason you wanted it, because it gave you the best chance of having to meet your goals, then you would own that. The reason we diversify is to avoid the risk of having all our eggs in one basket. The second is there's this recency bias that people, unfortunately, I think one of the worst mistakes investors make is they think that 3 years is a long time to judge the performance of a portfolio. 5 years is a very long time, and 10 years is infinite, that they can't wait that long. Unfortunately, that is so wrong because every single risk asset, whether you're talking about the S&P 500, international stocks, emerging market, real estate, gold, it doesn't matter, goes through long, much longer than a decade, periods of poor performance. Here's this slide that you put up there is my favorite example. Here's 40 years where US large and small growth stocks underperform long-term treasury bonds, which is the totally riskless investment for a pension plan with nominal obligations. So you wait 40 years and then you say, get out. And of course, the period since 08 has been the best period ever, maybe for growth stocks.
So let me see if I'm clear on what this slide is telling me. So this slide is telling me that today's darlings, large growth stocks, underperform treasury bonds over a 40-year period from 69 to 2008.
Yeah, Jeff, do you have that slide with the 3 circles on the 3 periods? If not, I could put it up.
I got it right here.
There you go. So this is, I think, a really important chart to answer the question you asked, why should I own anything other than the S&P 500? So here's 3 periods of at least 13 years where the S&P 500 underperformed basically cash. So 1 month treasury bills, okay? That's 45 cumulative years out of the period starting in 29, which is 95 years. Almost half the time, stocks underperform cash. That tells you.
Well, U.S. stocks.
U.S. stocks, not broad market, okay? So this is telling you the other 55% of the time, you had spectacular returns. But the only way you could get it is if you stayed the course through those whole periods and then continued to hold. But there's another unseen part of this chart that people need to think about. Let's look at the first period. What preceded 1929? Everyone's familiar with the term the Roaring 20s. We had spectacular returns. The most famous economist in the country at the time, a fellow named Irving Fisher, said stocks have reached a permanently high plateau. He said that in September 1929, just before the crash. And so the reason stocks did so poorly, partly was, of course, valuations were so high. Now, we did get a Great Depression and a World War. But after 43, okay, stocks were now at very low valuations. Nobody wanted to own them because they did so poorly. And stocks had spectacular returns, especially in the 50s and mid 60s. That's the era of the Nifty 50, which is like the Max 7 today. There were 50 stocks trading at roughly 50 PEs, like Coca-Cola and Digital Equipment and Data General and lots of other companies you never probably even heard of if you're younger because they've disappeared. So you had these spectacular returns which drove valuations way up. And then for 17 years, stocks had very poor returns. In fact, I think it was in 1981, Fortune magazine wrote an article, The Death of Equities, saying stocks would never do well ever again. And then when valuations were very low at the end of 81, the PE ratio was way down, trading like at 6 or some number like that. Then we got great returns up through 99, and then we had the awful returns, okay? So this is where we are today. We're like at the previous 3 periods when valuations went way up. I'm not making any prediction that we'll see another 10 or longer year period of US stocks underperforming T-bills. My crystal ball is always cloudy, but it's a warning why you should not concentrate all your assets. Do you have the slides? If not, I could put them up.
Yep.
From
Which one?
my, what do you do when a strategy performs poorly?
Yeah, that's what these are.
Okay, so let me show 95. So let's leave that one up and I'll start from there. So this is the most recent 17-year period. And this is why, because of relativism and recency bias, here you see the returns, why people are asking, why should I own anything other than the S&P 500? And why would I want to own international and especially emerging market stocks? Okay, so now let me take you back to the period just before that. So how does the world look to you in January 1 of 2008? You don't have a clear crystal ball. You don't know what the future is, but you're subject to relativism and recency. And you see these returns. The S&P was the single worst returning asset class, and by far the best were US small value and emerging markets. So what would you have owned? You would have said, get the hell out of the S&P. Let's load up on small value, which then went on to underperform, and emerging markets, which was the best, went on to underperform. But let's go back one more period. And here's this slide. And now you look at this and you say, why do I want to build a diversified portfolio just to own the S&P? And I certainly don't want to own emerging markets, but we just showed you, put back 2000 to 07, Jeff. And there's what happened if you only own the S&P. This is why we think it's absolutely critical. And the only prudent strategy is to own a diversified portfolio, which doesn't protect you from bear markets, because sometimes all equities go down, but it protects you from having all of your eggs in the wrong risk basket. And there's nobody who can predict which basket is going to do well when, and when these changes in regimes are likely to happen.
Yeah, this is a slide that you sent me that I edited a little bit. So this slide basically shows what some call the lost decade, and the bottom, I guess, aquamarine looking color is the S&P 500. So from January 2000 through December of 2009, the S&P 500 was negative. It compounded about -1% per year over the decade.
And that's compared, you got to compare that to T-bills, which
right.
might have got you 4 or 5.
which is the green line. So the green line is T-bills, and the aquamarine, or the bottom line, is the S&P 500, and then the top line is a globally diversified balanced portfolio. So that was just my way of trying to take your slide and try to show a little bit more.
Great example, Jeff.
Diversification. I'd love for you to walk through what you mentioned earlier about expected returns at today's levels. And I don't know if you want the PE ratio first, or you want the earnings yield first.
Let's show the Cape 10, which is what's called the Schiller, named after Robert Schiller, a Nobel Prize. Well, let's put the other one back up, Jeff.
Okay, yep. Okay.
So the Cape 10 is just the cyclically adjusted price earnings ratio. So Warren Buffett's famous mentor said you shouldn't look at only at current earnings, because they could be way up because we're in a boom, or they could be way down because we're in a recession, but they're not, neither is permanent. So let's take an average of longer periods. There's nothing magical about the Cape 10. You could use 5 or 7. Schiller happened to use 10. And they all come up with about the same answer. It is, while it tells you nothing, as I said earlier, about the next year returns, it is the best predictor we have of the next decade or longer returns. So the Cape 10
after inflation. So these are real returns.
After inflation. So this is real returns. So I'll explain here. So the Cape 10 today, I think, is something like 37 last I looked. So if you invert 37, because that's a PE, we want to get the earnings yield, that's telling you the real expected return to the S&P 500 is 2.7%. Add in, let's call it 2.5 inflation. So that's telling you you should expect the median of a wide potential dispersion of outcomes, because you don't know. You could do better or you could do worse. but the median is only about 5.25. The valuations are much lower because they have not performed as well, okay? And by the way, 70% of the outperformance of the US over this last decade had nothing to do with earnings. It had to do with the PE ratio of US stocks going up due to optimism and who knows what else, driving valuations much higher. So most of the outperformance came from speculation, not earnings. The PEs are much lower, so the earnings yields are not high.
Much
In
lower in
Europe and
international.
emerging markets.
There you go.
So the expected return for developed markets is 5.5. Let's add 2.5 for inflation. You should expect about 8. And emerging markets more like 9.5. We can see the same thing, Jeff, if you want to put up the next slide, which looks at the current earnings yield, the PE ratios. You'd have to invert it to get the real expected return. But you could see here that US stocks are trading like 60% more expensive than international emerging market stocks.
Yeah, and you see it. I'm sorry, I went too far. You see it right here. So on the left there, you see the S&P 500, the PE ratio on the S&P 500 at 21.5 in the top left there, and the international stocks, ex-US, about 13 times earnings. So that's essentially what you're saying. Just the expected returns are much higher because the prices are lower.
Jeff, so if you keep that slide up, the one chart on the left, if we created the 3 periods before the circled periods where the S&P did very poorly, the chart would look exactly like that. In other words, declining earnings yields predict future low returns with pretty good accuracy, but they tell you nothing about the next year or two.
Okay, so let me close the loop on what I think you just said. Was since we can't forecast markets, we shouldn't try to time and predict, what's going to happen next, but we can use valuations to get some sense of expected returns, and you don't want to give up on both international diversification and broad asset class diversifications like small value or other sectors. You don't want to be concentrated just in large U.S. stocks that are fairly concentrated.
Yeah, so let me add one other comment to be helpful for the audience. So what value do they have if you can't time the market with it? As you pointed out, it gives us the best median estimate of the returns, which can help us. We can run a Monte Carlo simulation and say if we have, call it a 60-40 or a 50-50 or a 40-60, run different asset allocations, what are the odds we're able to achieve our life goals that we want to have? And that can help you make decisions. And the higher the expected return, the less equity risk you need to take. And the lower the expected returns, the more equity risk you need to take, which is kind of a paradox, because the lower the expected return means you need to take more risk. So you then have to decide, is that risk worth taking? Or am I better off lowering my goal, maybe spending a little less now and saving more, or looking at other assets that instead of just traditional stocks and bonds that might be able to allow me to achieve my goals.
Right. I want to close the sort of your part of the presentation here with 3 core principles that you have shared in a lot of your books and material on how investors should go about building principles about building anti-fragile or broadly diversified portfolios. So can you just touch on this briefly?
Yeah, so first, anyone who's interested in the subject, I wrote a book called Reducing the Risk of Black Swans, and it goes into great detail, and it shows how you can create more anti-fragile portfolios, which reduce the risks of bear market crashes, which can seriously damage portfolios, cause people to lose sleep, let alone their assets. So these are the core principles that I believe every investor should follow. The first, and it's all based on peer-reviewed evidence. These are not my opinions. And it's the way the biggest, smartest institutions in the world invest, like the Yales and Harvards of the world. The first principle is based upon the research shows that active management is a game that it's possible to win, but the odds are so poor you shouldn't try. That means today we know that only about 2% of managers, mutual funds, outperform an appropriate risk-adjusted benchmarks over the long term, which is less than you would randomly expect. So we know you're better off just using systematic strategies, or worse, more common, it's passive, like index type of funds, or the funds of families like Dimensional and Avantis. So we don't want to use strategies to try to pick individual stocks or time the market.
Okay.
If you believe that the markets are efficient, which you should, because while they're not perfectly efficient, they are highly efficient. So then we invest in these types of vehicles. But once you believe the markets are efficient, you must also believe, it's the only logical conclusion you should make, is that all risky assets have to have similar risk-adjusted returns. That doesn't mean similar returns. So for example, high-yield bonds are clearly riskier than treasury bills. So they must have higher expected returns, but they're clearly much riskier. So if we adjust for the risk, one way to do it is to consider the volatility. Once you adjust for that risk, then they should have similar, what are called Sharpe ratios, which take returns and adjust it for risk. And that's what the evidence shows. Almost all risk assets have similar risk-adjusted returns when you account for all risks, including what I refer to as the illiquidity risk. There are lots of assets that are illiquid, like private real estate.
Yeah.
But
Okay.
I'll just mention, if you don't need liquidity, then you could take advantage of it. And the Yales and Harvards of the world don't need liquidity, so they have the ability to earn that premium, and it's not really a big risk to them. The last point is this: if all assets have similar risk-adjusted returns, like emerging markets and S&P 500, clearly emerging markets are riskier. You saw the markets are pricing for that risk. They have higher expected returns. That does not mean emerging markets are a better investment. It means they're riskier. Once we adjust for the risk, then they should have similar risk. So that tells me, if I can't predict which will do well when, which there's no evidence anyone could do that, and they all have similar risk-adjusted returns, the only logical, prudent strategy is to be highly diversified, or of course, all the assets you are comfortable owning and are willing to stay the course with, absorbing 10, 15 years of bad performance, because you know that not all of your eggs are in that basket, and you can wait it out.
Perfect. Yeah. Well, I've got a few questions here. So we've got about 10 or 15 more minutes to go in terms of time that's allotted for the work, for the webinar. So let me just hit a couple. The first one that I've got, Larry, is someone in the audience asked, "What's the fascination with Bitcoin? Is it a commodity? Not. It's a commodity, not an investment." So, any thoughts on Bitcoin and Trump coin or anything digital currencies?
Yeah, well, first I wrote a piece a few years ago on this subject. So Jeff, if you would like, if you don't have it, just shoot me an email. I'll send it to you, and you could send it to your clients on the call. So here's the way I think about this. First of all, the technology behind Bitcoin, this blockchain technology, is game-changing and is going to change the world in very positive ways. And how contracts are written in exchange, how money can move around the world, provides all the evidence, and you can trace transactions and move money instantaneously, where today we even have 2 days trading to get out of a mutual fund before you can get your cash. So that makes no sense. That's going to change. But that has zero to do with Bitcoin. The thing is, Bitcoin is certainly not an investment, because any investment, you should be able to estimate the cash flows and then put a risk premium on them, and then estimate the present value. There are no cash flows. It's a pure speculation. You might call it a commodity. My view about Bitcoin is this. The most important thing you need to understand is something is worth whatever somebody is willing to pay for it. Now, I don't know, most people on this call probably aren't aware that seashells were once a currency in many places in the world, until somebody figured out there's an unlimited supply of seashells. And when you have an unlimited supply of something, the price goes asymptotically to zero, okay? What you need to know about cryptocurrencies is Bitcoin is one of today over 10,000 cryptocurrencies that can all do the same thing. And therefore, my view is the value of Bitcoin is just as likely to be close to zero as maybe someday it'll be worth $1 million. But if I had a bet, I would put more odds on the closer to zero than $1 million. And for what it's worth, and I don't invest in Bitcoin. I wouldn't recommend doing it. If you want to do it, put 1 or 2% of your money in so you don't go bankrupt if it goes to zero. But I think the two finest financial economists in the country today are Gene Fama, who's got a Nobel Prize, and his son-in-law happens to be John Cochrane, who writes a blog called The Grumpy Economist. He's at the Hoover Institute at Stanford. And both of them would repeat virtually what I have told you. So at least I have a little more confidence that my logic is right. It doesn't mean my forecast will be right, but it clearly is not an investment. I view it purely as a speculation. But again, you know, it doesn't tell you anything about what the future price might be.
Yeah. Okay, got a couple more here. So you touched on this earlier, but and this might get into the realm of asking you to forecast, which we don't want you to do, but a lot of people are asking about the impact of tariffs.
Okay.
Because
so
obviously there's debate around that.
This is a very important question because it could have a big impact. Problem with making a forecast about tariffs is we have great uncertainty about what's going to happen. Often what President Trump says is a lot of bluster and positioning, and he ends up using it as negotiating tactics to get a better deal. And he's done a pretty good job of that. All the people, for example, forecasting huge inflation because of tariffs, one, totally ignorant of the historical evidence, which shows it's just as likely tariffs can be deflationary, and I'll touch on that. But in his first administration, they increased tariffs significantly, and inflation was under 2%. So, you know, I don't know where all this thinking is coming from. There are, and here's why you can't forecast. First of all, we don't know what the US will do, whether we'll put 60% tariffs on China, or he'll get China to agree to buy US natural gas instead of Russian coal or Russian oil. And the same thing with other countries. Get them, you know, France to allow US imports of, you know, our wheat, which they basically outlaw. And, you know, all of the countries have basically taken advantage of the US. We have gotten the raw deal. Trump is absolutely right in that, in most trade negotiations. So if we get the following, one thing can happen. Tariffs get imposed and prices go up by that amount. But here's the problem. That does not cause inflation. That causes a change in the price level of some goods. Now, if the Fed doesn't print any more money, if you have to spend more to buy a washing machine, you have to spend less then on other things, which lowers their demand and likely holds their prices down.
Yeah.
That's number one. Number two is it's a one-time adjustment. You put a tariff on, it raises the prices, and then, so maybe you get more inflation in that year, but it has nothing to do with inflation in future years.
Gotcha.
So that's a second point to understand.
Yeah.
Second outcome possible is, let's say we impose tariffs on China, and China decides that they're going to let their currency fall sharply, offsetting the tariff decline, and then China paid the cost of the tariffs not US consumers, because they want to maintain their global market share.
Great.
Third possibility is US imposes tariffs on China. China says, oh, interesting. We're going to ban all exports to the US of critical rare materials that you use in your military and computer systems and cars and everything else. And Canada bans or charges exports on US imports and charges for US importing Canadian oil. And boom, everybody, we stop importing because they're charging more, and we stop exporting because they're going to have to pay more, and we end up with a global recession.
Wow.
Now, if you could tell me which of those outcomes is likely when we don't even know what Trump is actually going to do, then you're a legend in your own mind. That's the best way to put it. There literally are no good forecasters, and the best you could do is assume the market knows everything you do, is making its best guess, and right now is that probably going to be some tariffs, but not that bad, and the world will go on, and the US economy will do fine, and maybe inflation might pick up a little bit, but not a lot, and we're not likely to get a trade war because nobody is that dumb, because in the end, everybody loses. But we don't know, and any of those outcomes are possible.
Yeah, very cool. Well, this has been very helpful, Larry. Thanks for chiming in and being a part of tonight's webinar. I really appreciate it, and I appreciate the assistance you've been giving us as we think through some of the work that we're doing in our strategies. I mentioned the article that Larry put out, so we'll send a link out to this article so you can see a review of his fourth quarter economic report that was in wealthmanagement.com. So we'll send you a link to that if you would like to see
Jeff,
that.
One other thing I'll mention there, I just published an article today on the US economy and why you should consider international investing, even though the US is more resilient. It's on morningstar.com. So
okay.
You could get that and send that link. That just was published today.
We'll share that out as well with this article. And then just want to remind you that TandemGrowth Financial Advisors would love to have a conversation with you if you're not a client or know someone who needs some help with their planning. And the first step in our process is super easy. It's an introductory, just get to know you phone call just to see a little bit about who you are and what you care about and what you're looking for in a relationship. And if we can help you, we would be delighted to share with you how we work, and we can move forward with a more substantial conversation here in our office. Or if we're unable to help or we're not the right fit, we'd be happy to introduce you to other ways that you might go about trying to find an advisor. So again, we'd love for you to share our information with your friends and colleagues. If you haven't subscribed to our mailing list, you can certainly do that at info@tandemgrowth.com. We did launch a new website just in the last week. So I'd love for you to check it out and tell us what you think. So there's some additional resources there. And as I mentioned, first step to get to know us is super simple. You can just reach out to anybody on the team, and there's the team. So it's been a pleasure having you with us tonight. We really appreciate it. I hope you found some value for tonight's conversation, and have a great evening, and we look forward to chatting with you next time. Thank you so much. Thank you, Larry.